So in today's video, we are going to be talking about ZWC, which is an ETF by BMO. It's the Canadian High Dividend Covered Call ETF. Now, basically, is this a good investment today in 2021? And of course, the day I am recording this video is July, something my watch didn't want to work, July 24th. So basically, is this a good investment today? They just recently lowered their dividend by a penny, and they never came out and gave an explanation as to why, but I can assume that because the stock market moved so fast in the upwards momentum-wise, basically they probably just sold less calls so that they can keep more shares. And that's usually what happens when it comes to covered calls. So it's not really a big thing to really worry about unless we see it lower one more time. And then at that point, I would probably be getting out of it. But at this point in time, let's really look at it. So yield is 7.2%. We're still looking at a 7% dividend. This is huge. From there, what we're looking at also is something that has ridiculously high volume. This is what we really want to see so that we can get in and out in case it turns against us. From there, we do see that the MER is quite high versus other ETFs. However, it's in line with other covered call ETFs. A covered call is basically if you hold shares and then you are essentially helping somebody else gamble, where you say, okay, well, I'll give you 100 shares. I'll promise 100 shares to you at today's price, let's say 3 months down the road, only if that stock price hits a certain price. Let's say it's $60 today, and I guarantee you to sell you 100 shares, let's say 60 days down the road at $80, and it's currently sitting at 60, and then you give me a premium, which is money, and then from there, if it hits that stock price, I give you the stocks for that set price. Or if it doesn't hit that $80 at that point in time, what would happen is you would keep your shares, you would keep your premium, and of course, nothing happens. That's why the dividend probably got cut. The reason for that is they didn't want to create those covered calls because they didn't know how high the stock market was going to go. But if you want more information on how covered calls work, I do have a very good video. I will try to remember to link it here. Either way, it's going to be on my channel anyways. Now, when we start looking at the chart, it has had some slight downward pressure ever since that it came out. However, the stock market also had that same trajectory anyway, so I'm not really too worried about that. This is still a fairly new ETF, so there is some risks involved if you're worried about losing money. However, what we did see is it dropped from $20 to $19 within a year or 2.5 year period, which is not really all that scary if you really think about it, considering the massive dividend that you were getting during that time, plus the fact that the stock market in Canada was not exactly doing great anyways. So this is not worrisome to me at all. What I am worried about is that it has not reached back to $19 at this point in time from that downfall that we had back when, of course, the virus was starting to be spread. Meanwhile, it sits at 11-cent dividend up until recently, so that's a 1 penny drop that I did mention earlier. Last time it was a 10-cent dividend, it was back in 2018, and then they rose it up to 10.5 cents, and then later up to 11 cents. It's been sitting at 11 cents almost like if it's its sweet spot for multiple years. So again, not really too worried about that drop. We'll see what happens in 2 or 3 months if they raise it back again to 11 or maybe even 10.5. And some of the biggest holdings are CNR as well as CIBC. Of course, banks are going to be heavy in Canada. BCE, which is Bell, Enbridge, TELUS, Manulife, and again, another bank, BMO. Overall, fantastic holdings. You're going to be grabbing dividends from these anyways. However, on top of it is going to be your premium that you get for selling those call options. So at this point in time, is this a good ETF? In my opinion, yes, it is. I'm in it. My family members are in it. I still feel like this is a very good ETF. Even though they cut it by a penny, you're not cutting a dividend. You're cutting basically ROC, which is return on capital, which is going to be those call options that they're selling. Why would you make less money on for on something like this is mainly because you're not having the same size of return on capital, which could be one of three things. You're not selling enough call options to cover that dividend, or you may have sold a few call options and of course those got filled and now you have to buy back stock, which is usually rare when it comes to these ETFs. Usually the stock price itself would tumble at that point, which we haven't seen. So that's now leading me to really think that of course the call options just have not been being sold recently, or they just don't see themselves selling as many call options coming into the future, or at least in the short-term future. So because of that is the reason why I think that they lowered the dividend, and it's really not that much of a worry anyways, because you're really just cutting return on capital and not the dividend itself. When you can see dividend cuts, that's when the banks and those companies that they hold are cutting the dividend. When you see an ETF like this, like a covered call cutting a dividend when none of the stocks inside of the ETF are cutting their dividends, it's because at that point it's the call options that they're selling are not making the same amount of premium as they were before. So that's the reason why. Anyways, I still think this is a fantastic ETF, especially for the future, especially when we see what's going to be happening. One of two things are going to be happening with the market. It's either going to be sitting still and it's going to be trading sideways because we don't know what's going to be happening. And usually when we see the stock market trading sideways, there's going to be some high up and downs in between that, but really not going anywhere. Or it will explode to the upside. I am more leaning towards the explosion to the upside because Canada's not open yet. Mostly, we're just starting to reopen now. There's going to be probably a good 2 years of growth when it comes to our economy. Of course, there's going to be fewer jobs because there's going to be more businesses that have figured out how to run with fewer staff. So there's going to be less jobs, but because there's going to be people looking to visit our country, maybe moving into our country as refugees or maybe just immigration altogether, we are still a massively growing economy. Our stock market hasn't shown that for the past 5 years. So over that, I think that our economy is going to be doing extremely well. And just overall, I think our stock market is going to do just fine. Anyways, I hope that you've enjoyed today's video. When it comes to covered calls, you don't want to hold it while there's massive upgrowth. However, at the same time, you can still participate in a little bit of the upgrowth, get a little bit of that massive ROC, the dividend. However, at the same time, if you're looking for a big dividend, this is great. If you are looking for growth, there's other places to really be investing in. Anyways, I hope that you've enjoyed today's video. I'll see you guys again next time.